Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So another event out of the way. Fed came and gone. They did basically what the consensus said. They extended Operation Twist. They put it all the way out to the end of the year. They kept their language that they can keep rates low all the way through 2014. There were really no curveballs, no surprises, no creative QE. There was some insinuations that they're ready whenever we really need it. But obviously, when the NASDAQ's up 12% and the S&P's up 5%, there's not such a need to use all your bullets in a gun or a bazooka, whatever it is you're talking about. So what I want to do is I want to just talk about commitment to a rally, because we've had a nice move off the lows. It was fast, it was furious. IBD has us back in a confirmed rally since last Friday. Since that day, we've seen the rally broaden out. We've seen some leaders flex some muscles, and today they tried to sell that news, but it really wasn't severe, it wasn't drastic, and stocks didn't fall apart. So everyone will come out, everyone will give their opinions, but the bottom line is the market's going to give its opinion on whether or not we see higher prices. So today I tried to post a blog post about Fibonacci retracement rules. To me, I think they help measure the validity of a move, because it measures where the dip buyers come in, to see whether or not they wait for lower prices or they're that pent up that they need to get in now, so you could then adjust your speed accordingly. So today we saw a move lower that was met and we closed okay. Who knows, we may not even get to the 25% Fibonacci retracement, which is considered very, very strong. So right away, just off the bat, if today's low is the low, then you're going to have a lot of traps, shorts. You're going to have a lot of people who are not in this rally. You're going to have a lot of people hating the stock market, and we're going to go up to the higher level pretty damn quick. If we could consolidate, go sideways, hit the 25% Fibonacci retracement, I think it would be more constructive, and then I think the 38.2% would be the best. So right now I'm just going to go into some of the sectors, and let's go into it so you can write them down and you can see for yourself where we could go, and then we'll along the way obviously measure the strength of the leaders and what's going on. So here is the spiders. So if you take a look here, this is what we broke down from yesterday. Wrote somewhat of a note to try and get a cute short, look to see if you could reduce long, see what comes next. And then this was today. Today we matched the previous day's low somewhat, and we held in there. So right away, it's kind of putting in a floor. Remember, after we had this move, off the lows, we put in this floor right around here, and the market proved it could hold higher. We proved we could hold above 131-ish. Well, right now, we have a new floor here at around 134 and change. And now, perhaps with a few days of sideways movement, we could break above this recent resistance, and then the measured move that we've talked about many times here from the break of this inverted head and shoulders pattern really takes it all the way up to almost 140. So it'd be nice to have it a little bit more tradable versus an elevator up. So right away, if it becomes relevant, because right now, who knows if this is the floor or we go lower, you can put your Fibonacci retracements that go from the low to this recent high here, and basically this is what you have. In the spiders, you have your 25% retracement right around 134.02. So we did hold above that, so it's showing a lot of commitment. It's showing people aren't even letting this market come in. We'll see if that transpires or stays the same. And then you have the 0.382% retracement, which is like 132.82, which also kind of lines up with the upper level of the range that wound up holding before we broke out. So I would love to see it come into this area, because I think it would be methodical. We'd have some nice charts. You could buy it. But again, we don't know what the market's going to do. It could just hold here and then continue, or who knows what happens with the gap up tomorrow or gap down. So at this point, here's your short-term pivot low or support, and here's your resistance, and here are your Fibonacci levels. For this rally to be any good, which we don't even have to start talking about yet, you would think that, again, this floor that was put in place would hold, which would be the 50% retracement, or a little bit higher than this entire move. So let's now go to the Qs. Qs, if you look at it, all in all, not really leading the way it led in the past. It's more in line. Ever since this nice little reversal here, look at this red dog reversal. Okay, you had your red dog reversal here. Nice pent-up energy a few days. Then it also held higher. Same thing. And now here's your floor. Here's your floor in the Qs. So it held higher. 63.81. That is now your short-term pivot to trade against. Here I would say is, I guess the descending type of trend line here, so it has some room. It also has a gap up here. But anyway, here is your short-term tactical area to trade against. If you want to go into Fibonacci's here, same type of scenario. You want to see where we hold, and as of right now, it's holding higher. So it's creating actually a flag type pattern versus even pulling in. I would have loved to see some type of retest of this area, and if we want to see where that is on the fibs, you go to your fib retracement from the low here, right there, all the way to the recent high, and there you go. Here it is. The 25% retracement is lower than this flag. That means you would have to break below today's low to get here, which would be about 63.46. And then again, the 38.2% retracement is very symmetrical. It also, it lines up for a retest of the breakout above this little descending trend line here. So these are your levels: support 1, support 2, support 3. We'll start talking about the rest of these if we have to, but as of right now, I don't think we have to. So that is the cues. You want to talk a leading sector that's doing really well, RTHs. RTHs are still hovering near the highs of the overall year. So much closer to the highs than the diamonds, the spiders, the Qs, the XLI, you name it, it's up here. So this, in my opinion, is going to be the first group, or one of them, to make new highs in the year, and then stocks within this group are probably the ones that are making new highs and rewarding investors for staying the course. So right now for the RTHs, you have a 42.01. That's your area. And I don't even think we have to, it's like meaningless to do the fib retracements because they're probably not even going to come into play, because to me it seems like it's just going to be a matter of time until it breaks above this 42.50 area. So you have 41.85, which is a level of support if we come down into there, and then the 0.382 is right here. But to me, I think it holds in here, and then you get your breakout. I hate to say my stock of the year, but it's interesting this Wal Mart just continues. Wal Mart, which the reason being, remember that 10-year base? Woo! 10-year base breaking higher. Not because I love Walmart, not because I shop there, but I do. So does my wife. She actually likes Target a little bit better. This is a lot of time that it consolidated. A lot of institutions bought a lot of damn stock in this, this big 10-year channel, and now it looks like it's ready to go. Absorbed the big move, continued. So that's your ultimate bull flag, but it just took a decade to get there. So all in all, still acts strong, and it's on the verge of breaking out again. So Walmart, which is a big component, obviously, of the retail arena, is looking good. So does that sector. I know some guys tried to short it in here, thinking that you have to have a high-level stop, which made sense to try, but once it didn't work, here was your out. You always have to have stops on the buy stop side versus the short side too. Let's see, Target. Target, I would put on the radar as a potential long/breakout play because it's acting very well. You now have a nice flag type pattern, and above this area, it can continue. We talked about how it changed composure right around here, and it's shown nice commitment. This is a leading stock. I'm not going to get into some of the other ones there, but I wanted to continue the retracement game. XLI, not really showing relative strength. It's kind of in line with just the spiders. So same type of thing. It's holding above the moving average. It looks like it's going to try and flag again. You go into your Fibonacci retracements. It's the same type of game if you're playing these industrials. But as I look at these things, it makes me believe that we're probably not going to have to write them down because we're going to hold higher. But just in case, here we are at the 25% retracement show. So it actually pulled in more. It actually broke below yesterday's low, where you saw the spiders really didn't, the Qs didn't, the RTHs didn't. So this is still a weaker group, these industrials, just on a small little micro sense. And then here's your 0.382. If you want to look at the OAHs, they've been just a laggard this entire year. You had a nice trade in the beginning of the year from December all the way up until it failed. But when you see crude breaking levels here with no rally, this is like your typical bear flag. Boom, move lower, lower consolidation, couldn't get a bid. you know, breaking below recent area. Next level for these USOs down here is around 29. You know, that's about 76 for crude. One of these days, that will actually be a positive for the consumer if the gasoline or the gas stations ever reduce their prices. Maybe the regulators should go start looking at them instead of just the banks, you know, and that really will help consumers if the gas prices are cheaper because the oil is a lot lower. Today, with the banks, they were a source of strength because JP Morgan came out in news that they covered about 70% of that big well trade, and it showed strength all day long. You go real quickly to the XLF just to see relative strength-wise on a micro basis. Look, you saw how the XLI and the OAHs broke below yesterday's low. XLF did not. That's a positive, short-term little positive. It's coming into some bigger resistance here. Looks like it can continue. JP Morgan was strong all day. Gapped and made it through this 200-day, and then I think your next real level here is the gap from the earnings. Remember this day? Remember we were in here, it was down 30 cents. That's when they announced their $4.2 billion loss versus $2 billion, down 30 cents when reversed. That's a by the news scenario. And now look where we are. Held higher here, and now it's coming into resistance. So it shows how you could tactically, you know, be involved if you weren't involved in the mess. You could time these things, guys. As far as just real quickly, Apple still hanging around, still above the 50-day now, above some of the moving averages. The next momentum buy will be through 590. Unfortunately, I don't have a position. I got stopped out today because I was being a little bit too micro. I stopped myself out below 583.10, and I wanted to be tactical or just flat for some other purposes, compliance-wise. But you know, I'm gonna re-enter a lot of these things if they start to go. And above this 590, I do think next area will be to fill this gap at 650. So that looks okay. eBay, just real quickly, inside day, no big deal. That's what happens after you have 1, 2, 3, 4 up days. Still looks fine. A lot of these things all are having inside days. A lot of them aren't breaking down. People aren't running for the exits yet. So at this point, yeah, it was a cute tactical short. We talked about it yesterday. I tweeted about it. I said, you know, 135.75 to 136.25. You could cost average into a short, or 13.57 to 13.63. That's where you should put on some hedges. Well, today we were about $2 off those highs. You could have taken the trade, made some money. You could have covered some of your hedges, added to some of your good positions if you want to stay with them. If that's how you're maneuvering this situation, instead of being tactical and just flat, you could be in 7, 8, 9 stocks that you like, you know, with a spider hedge on, and just keep maneuvering. And if you want to do that, follow Sperling. You can see on his virtual trade floor, he's got like 14, 15 positions, so he's trying to stay with it. So you can either be tactical for cash flow, you could be intermediate with 8, 9, 10 positions with a little bit of a hedge on and maneuvering it if you want that stress. Or you could also, if you could be in your macro positions. We've talked about macro stocks, we've talked about Dunkin' Donuts at highs, we've talked about so many of them, you know, that you don't sell if you're never going to buy back, but you use a tier system. So when markets are in correction mode, you could be in tier 1 to stay with, as long as they don't start breaking their 200-day and start really breaking lower, like you saw some old leaders, whether it was your Lulu, whether it was your Caterpillar, whether it was your Google. Those all broke to 200-day and they went from macro longs into the penalty box until they acted better. But other stocks like MA, CMG, all these stocks that held their 100-day while the S&P went to their 200-day showed that relative strength, and they showed that they still were worthy of you holding them longer term. So with all that said, tomorrow's a pretty important day. Usually the day after the Fed is some type of trend day because the noise is out of the way. We have claims tomorrow. We have Jill tomorrow with the Ags. The Ags woke up a little bit real quickly. The MU, same type of scenario, broke above this lower pivot with a nice gap, and then today held higher, didn't even come back and retest yesterday's low, so it showed some commitment, showed some strength. So we'll see if it stays that way before it starts to take out this area to continue, and she'll have a lot of news on that tomorrow. So Scott Redler, T3 Live, the recap. See you tomorrow morning at the call. Fed's out of the way, Greece votes out of the way, G20's out of the way. A lot of headlines are out of the way. Now we just have to see if the market trades better than the headlines read. We have the summit in the next week and a half, and then obviously the end of the quarter, which also has some markup Fugazi business. So if we stay intact, people are going to want their portfolios to look well. We're very close to the end of June, the end of the second quarter. So we'll try and guide you through that. Have a good night.